So when I look at BaaS players in the market, a modular tech stack, easy to integrate APIs, seamless journeys, they're all table stakes. When we speak to clients, they expect that as a given. As you'd expect at Box, we deliver on all of those through our innovative platform called Genie, but we don't consider them differentials. If I think about what makes NatWest Boxed special, there are probably three things. Firstly, it's the brand and depth of relationships. So clearly NatWest serves the majority of the FTSE 250, and there's trust and track record they're built out over decades, and we see that as super important, especially in today's kind of choppy macro environment. Then, of course, there's the balance sheet and funding. Clearly, we have capital to lend, which is very important, but also, if you think about the funding, we're funded for success, and when we speak to clients, this is paramount. They want a BaaS partner that will be around to deliver on its promises. They're not living from funding round to funding round. And the final point probably is around the banking license itself and all the capabilities that come with it. We're a full banking license, current account, interest bearing. We're not e-money. And that's supported with all the risk management and operational processes that you'd expect to scale up safely. This is probably, I would say, the hardest thing to replicate because, building those processes as a bank over years to make them safe and scalable, it's expensive and there's a high cost, but also there's a high jeopardy if you get them wrong, and they all come out of the box. So the opportunities that embedded finance and especially banking as a service models create are significant, and they're significant for all players along the commercial value chain. So starting, of course, with the consumer, yes, there is convenience, speed, and more opportunities for embedded tailored journeys. But I think the biggest opportunities for consumers is really improving consumer outcomes. Clearly, these propositions are powered by safe, regulated products designed with, conduct and consumer duty in mind. So really better outcomes for consumers as a huge opportunity. Moving on to distributors, I think the opportunity there is greater. So these are the consumer brands and financial institutions that are going to embed, use embedded finance in their propositions. I think the benefits there are significant. Some of the biggest ones are, of course, engagement with clients, loyalty, which will drive, bigger basket sizes, cross-sell, and more activation. Then there's new revenue streams being opened by BaaS, especially on the back of innovative value-sharing models between the distributors and the manufacturers, the banks. And in a current kind of higher for longer interest rate environment, that is something very interesting. Now, what else? There's speed to market. BaaS can help accelerate propositions. New businesses can test and learn, work towards their product market fit without the need to set up complex processes, which take a long time. And the final benefit, I think, is probably around, economics and efficiency. So, optimizing your OPEX line, the cost income formula through BaaS, like, for example, by lowering the cost of regulatory compliance, that's definitely a benefit. And finally, in the value chain, you've got the banks. For them, the opportunity is really an existential one. It's basically future-proofing their business models. So we know consumers are making decisions about financial products in brand, in journey, away from banks. So to remain relevant, banks need to embed themselves. But at the same time, they need scale to cover the high fixed cost of running these regulated lenders. So BaaS can help that. How? By acting as an accelerator for the balance sheet, also opening up new channels for these banks and manufacturers, beyond their natural market share. via the white label route. And finally, there's also the new kind of sticky fee income streams that are generated by these propositions, which definitely help banking valuations, which are currently not in a great place. Let's put it there. So, strategic partnerships are really long-term commitments for collaboration and co-value creation. And like any relationship, it's things are never linear and never clear-cut. So there are a few key success factors we look at when thinking about partnerships and, making the best chance for them to be successful. The first one is value share. Sounds obvious, but there needs to be clear value exchange between both parties. And both parties need to have clear line of sight towards the benefits they will get out when they put the work in. Linked to that, I think even more importantly, it's the importance of partnerships to the core strategies or plans of both parties. They can't be peripheral initiatives. This ensures that you have proper adoption, embedding, and really utilization of the service or product. The next one sounds obvious, but is senior kind of stakeholder buy-in. Now, clearly, any projects need senior sponsorship, but specifically here, what's very important is the senior sponsors of both sides need to be aligned and communicating. And then the final one is around ways of working. So to make these partnerships work, you need clear governance and clear kind of engagement models, because all partnerships will kind of run on the rocks and there'll be turbulence. So you want to ensure that you have almost a codified way to deal with these issues. So when problems come, you're working together, not against each other.